All right, day 38 of my journey to a $500,000 stock market portfolio. So let me go through my trades first, or my current positions in my margin account. I've cleaned up my margin account a lot. I don't have that many positions anymore. I'm trying to exclusively trade put credit spreads in my margin account and then covered calls in my registered accounts. But I still have some old covered call trades in my margin account that I'll hold until I can get out of completely. So I've got American Airlines. I've got 100 shares of American Airlines, but I bought at 31.5, and so right now it's trading at 29.6, so I can't get out of it now. Plus, in addition to that, I sold a call option at a 28 strike, so I really can't get out of it, because if I do, I'm going to be selling my shares at 28, which is lower than my cost of 31.5. So I'm still trying to roll over the call option as much as I can, hoping that either American Airlines drops below 28 or that I can slowly creep it up, slowly increase the strike for a credit. So for example, if I want to roll the call option, if I'll click create order, make sure I'm grouped by strategy. I'll remove the shares and then I'll add another call, sell. Now I already have January 31st. So let's say I go to February 21st. This one's at a 28 strike. If I take the same strike of 28, as you can see, I could continue rolling for a credit, but my strike is still 28. My cost is 31.5. If I go for a higher strike, I'm going to end up paying for rolling the strike higher. I'm going to be paying probably 50 cents, but I get an extra $1 of capital appreciation, because instead of selling the shares at 28, I'd be selling it at 29. But I don't want to roll for a debit. I want to roll for a credit. So the closer the stock is trading at 28, the easier it is for me to roll for a credit, even if it's at a higher strike. But because the stock is trading at 29.6, right now it's hard for me to roll the call option for a higher strike. I have to stay at the same strike. And at some point, the further the stock is trading from 28, I might not even be able to roll for a credit. If I go, let's say, to May at a 28 strike, I can collect $1 credit. If I go to 29 strike, I can collect 30 or even more. See, the further I go, then I can collect a higher credit and I can move up my strike. If I go to, I can't go to 30 yet. It would be for a debit. It would be for a small debit though. So let's say I go to June, then I could do it for a debit. I'd be at a 30 strike. Remember, my cost is 31.5. So I would still be losing money if the stock is trading above 30 come June. If I go for a 31 strike, but then I go to August 21st, then I could do it for a credit. So I have to go all the way out to August 2020 just to come back to the 31 strike that I initially started with. But now the problem with this trade is that I'm holding it in my margin account. So I'm paying interest holding it in my margin account, and I'm not even making enough income to cover the interest. So that's one of the problems with covered calls, is you buy a stock at 30, for example, then it drops to 25, but you want to continue selling call options against it. You can't sell call options at a 30 strike because there's no more premium left. So you're forced to go at a lower strike, but then the stock decides to go over that strike. So now you're stuck at a lower strike, lower than your cost. So I also have an Amazon put credit spread expiring January 24th. I opened this on Tuesday, I believe, and at a 17.20 strike. Amazon jumped like crazy today. Don't ask me why. And it should be in, see, as you can see, it's already showing me a good profit. I wasn't able to close it though today. I tried, but because there's a big spread between bid and the ask, for some reason I wasn't able to close it, although Amazon really jumped like crazy. But at least it's in a profitable position, so I'm not really worried about it. If anything, I could hold it till expiration and keep full profit. I think I collected about $85 on this trade. Amazon January 24th, I collected $89 on it. So I still have my box covered call. I had to go all the way out to March 20 to keep the same strike of 20. Collected 54 cents times 200 shares. So I bought the stock at 20. The stock is trading at 17.25. So I'm down $500 on the stock itself, but I keep selling call options against it. Dell, but it's a covered call trade. I bought it at 52.8. I've been selling call options against it for a while now. Last one, always at a 52.5 strike. So I never had a problem there, but the amount of premium that I collect was always different. It really depended on where the stock was trading at when I sold that call option. Regardless, the stock is now trading at 52, so it's close to my cost. I've got two DIAs, vertical puts or put credit spreads. One at 280 and the other one at 279. One expiring January 17, the other expiring January 24th. I think they're both showing a small profit. So this one's showing a $3 profit, so it's not ready to close. This one is close. Collected $80 on this, and I could probably close it for around, as you can see here, somewhere in between 33 and 46. So that would be 50% of profit. So if tomorrow DIA is still trading at this range, I could probably close it. I've got 2 put credit spreads on IWM, January 17 and January 24th, one with a 163 strike and one with a 162 strike. Well, IWM is trading at around 160, almost 167. So this one collected about, I think, $67, and I could probably close it for 54, so it's not ready to be closed. I aim for a 50% profit of the premium collected. This one should be ready to close. I mean, this one, it's already showing. Yeah, this one definitely I could close tomorrow. So let's see how much I collected. I don't remember. So the January 24th one, I collected $63. And then the January 17 one, I opened it December 18. Yeah, so I collected $76 on that one. So half of that should be 38. So yeah, I should be able to close it tomorrow if the ETF is trading at the same price tomorrow or even higher. I've got 2 put credit spreads on MasterCard, January 17 and January 24th. Let's see if I can close the first one. So yeah, I think the first one can be closed tomorrow. We'll see. The January 24th one is still not ready to be closed. It's actually not showing me that much of a profit. I've got a Netflix put credit spread that I sold at a 300 strike, expiring January 24th. It's showing me a very small profit of $2 only. I collected about $95 on this one, and it's not ready to be closed, but I still have 29 days to go, as long as Netflix stays above 300. I've got 1 put credit spread on the Qs, expiring January 24th. This one collected $75, and right now I could close it for around $56, but of course it's not 50%, so I'm not going to close it, and I still have 29 days to go. In fact, I closed one today, the one that was expiring January 17. I was able to close it for 50% already. See, and the one for January 17, I had opened December 18, collected $80. I was able to close it today. So about 8 days later, I was able to close it for $38. So more than 50% of the initial premium collected. I've got 4 put credit spreads on the SPY. I closed one today actually for 50%, but I'm still left with a January 17 one, January 21, 24th, and 22nd. And the strikes are pretty high, but what can I do? The SPY is trading at 323. So 317, 316, 316, and 315 are my strikes. This one's showing me a profit. This one's showing me, they're all probably showing me a profit, but not ready to be closed yet. So they're all showing me a profit, but just not ready to be closed because it's not showing me a 50% profit. But actually, if I look at the January 17 one, I could close it for around $40. I think I collected about, it shows here, I collected $80 on it. So yeah, this one could be closed tomorrow actually for 50% profit. Got a put spread on Tesla, expiring January 24th at a 375 strike. Collected $78, I believe, or $75. So it's not ready to be closed. Yeah, not ready. But it shouldn't take time with Tesla's crazy rally and keeps going up every day. And plus I still have 29 days remaining. And I've had some profitable trades on Tesla or put spreads that I just closed recently. So I've got this one here, January 17, that I opened for $1, closed it for $44 in 5 days. Then I opened another one December 24th, so Christmas Eve, collected $75, and that's the one that I still have that isn't ready to be closed, but is showing a small profit. Now I've got an Uber covered call trade. That one's not doing good. It's similar to the American Airlines issue that I had, except that it's much bigger. I bought the stock 40, sold several call options, and then the stock dropped to 25, 26. So I ended up selling at a 20. Actually ended up selling at a 27 strike, but I kept moving it up for a credit as long as I could. So right now the highest I'm at is 29.5 strike, but my cost is 40. So I don't want to sell this stock at 29.5 or else I lose $10 per share. So I need either Uber to drop below 29.5 before January 24th, or I got to keep rolling my call options for a credit. So for example, 29.5, if I decide to roll it for a credit, it's still too early. Probably 1 week before January 24th. So the week of January 17, I'll probably try to roll it over for a credit depending on where Uber is trading at. But for example, if I go for February 21st at a 31 strike, I can actually do it for a credit, a very small credit. So it would actually be a good idea for me to do that. 31 is above the current price, and I would be able to roll the call option to a higher strike without losing money. I'd be able to roll it for a credit. And if I go to March 20th and I go to 32 strike, I could also do it for a very small credit. But then I would still have to deal with Uber not going over 32 come March 20th, and that would be 3 months away. So I'd rather be close, at least 1 month away. And since I still have time for this one, I'll just wait. And then I've got United States Steel, which is a covered call trade as well. This one was trading above 14 and then it dropped all the way to 11. So I sold a call option at the highest strike that I could, where I can collect some decent premiums. So I sold at 14, collecting 10 cents a share, got 400 shares. This way I don't have to worry about losing my stock at a lower strike. Although 14 is lower than my cost of 18, but since the stock is trading at 11, it's still pretty far from my strike of 14. So don't have to be worried like I am with Uber and American Airlines. So in my TFSA, I've got useless Afria, biggest mistake ever. Actually, I've had bigger mistakes, but one of my many mistakes. So it's a covered call trade, a stock that I bought at 11.73, but the stock dropped 50% or more. And now I'm selling call options at lower strike. So I sold at a 7.5. while my cost is 11.73, but the stock is trading below 7.5. So currently I'm safe, but I've got two issues with this. It could either continue to drop like ACB, or it could shoot up and go past my 7.5 strike and put me in trouble. Regardless, in the meantime, I'm trying to collect premiums as I wait for the stock to come back up to my cost of 11.7, hopefully. Bed Bath Beyond is a good covered call trade. I've been selling call options on it for a while, and it's actually, the stock is trading at 17 and my cost is 12.45. My strike is 12. So I'm actually ready to let this stock go, but I just keep rolling my call option to the following month for a small credit. Why not? If I can do it for a credit, then why not? And it's not like I want to use the capital for something else, because I don't really know where I want to put my capital right now in my registered account, because I don't trust any stock. But the stock is trading at 17, so it's really far from my cost and my strike. In fact, I'll show you an example how I can roll my call option. So if I click on add call, sell, so this one expires January 10th. So let's say I go to February 21st, add 3 calls at a 12 strike. So the same strike, and I can roll it for a credit, probably like 20 cents for a 20-cent credit. Or come January 10th, I could just take my money back, get $12 per share. I've got CHK that I bought at 2.79. Right now it's trading at 94 cents. So another bad covered call trade. But I keep collecting call options, and the last one I did was at a 1.5 strike, just in case CHK goes up. I've got FCX, a covered call trade, not so bad. My cost is 11.43, but my strike is 11, so only 43 cents away. But I keep rolling over the call option and collecting a credit, so it's not so bad either. Grubhub is pretty bad. I bought the stock at 74, and then it dropped all the way down to 35. But I've collected some decent premiums from it. But now I was forced to sell a call option at a lower strike, at a much lower strike. So as you can see, my strike is 50, my cost is 74. So I'm $24 away from my cost, and the stock is trading at 49. So my stock is pretty close to surpassing my strike, and the expiry date is February 21st. So this can be problematic, but I just have to keep rolling the call option higher, or rolling the strike higher for a credit, so that I don't end up losing my shares at a lower strike than my cost. I've got Halliburton in the same position, but it's not so problematic because my cost is 23 and the last strike I sold it at was 22.5. So I could easily just keep rolling it, either the same strike collecting more premium, or roll it to a higher strike. So I'm not too worried about Halliburton. Even if I lose it at 22.5, it's not, I've collected more premiums than the 50 cents that I'm going to lose. IMGN, this one was a bad one. As you can see, my cost was 5.7, and then it dropped all the way down to $2, and I've been selling call options at a lower strike. But then the last strike I chose of $3 ended up being problematic, because this stock finally rallied back up. As you can see, I bought the stock in February 2019, and just recently, so almost a year later, it decided to come back up to my cost. But it was a bit too late, because I had already sold a call option at a 3 strike. So now I'm in trouble. If I let this go, my shares will get sold at $3, but my cost was 5.7. So I need to find a way to avoid getting my shares get called away. So I need to keep rolling the call option forward and hope that, well, actually I don't want IMGN to drop below 3, because then I would lose money on the shares. But I need to find a way to roll my call option higher without losing money. So if you try to look at an example, I'll have to go really far out. So let's say I'm gonna probably have to go to July, sell 4 shares, and let's say I could probably bring it up to 4. Even at $4, it's going to be for a debit. If I do it for 3, so only even at 3, I can't even do it for a credit because I'm deep in the money. I won't even be able to do it for a credit. So yeah, so it looks like I'm gonna end up losing my shares at $3 on this one. And Neo, so Neo's a stock that I bought at $5 and then it dropped up to 1.5 almost, but now it's back up to 2.5, and I've been selling call options at a 2.5 strike for a while. Got earnings December 30th, so expect movement. It might either go way up or way down, but I do expect hard movement for Neo come earnings. Because I've got a strike of 2.5, I don't really want it to move up or else it puts me in trouble. So I kind of prefer that it stays below 2.5. And then next month, I'll try to sell a call option at a 3 strike or a 3.5 strike. Finally, I've got Teva in my TFSA. Got 500 shares. It shows here 12.5 average cost, but my cost is more around $14-15. And right now it's trading at 10.14, but I've been selling call options against it. Last one has a 10.5 strike. So it's kind of safe, expiring January 24th, and I just keep collecting premiums. I just hope that the stock doesn't surpass my strike, which is lower than my cost. That's what's important right now while I'm selling call options on these stocks that have dropped hard. In my RSP, I've got Bombardier expiring January 17, covered call trade at a 2 strike. So this is profitable. My cost is 1.82, my strike is 2, so nothing wrong with this. This is a perfect scenario. Just keep selling call options every month. If it goes over 2, I'm just going to let it go and get my money back. I've got L Brands expiring January 17. This is a stock that I bought at 26 and it dropped all the way down to 17, I think. So I sold a call option at 20. So the 20 strike is lower than my cost, but hopefully I've been lucky. The L Brands has not been going over my strike, and I've been collecting premiums on this stock while I wait for the stock to slowly come back up. Novavax was another bad covered call trade. As you could see, it went through a split, I think, of 20. So as you can see, it shows here that my average cost is 32.28, but the stock is trading at 4. So this is probably my worst trade ever. And the last covered call trade I made on Novavax was an 8 strike for January 17, collecting 35 cents. So current price is 4, my strike is 8, so I'm pretty safe. I don't have to worry about Novavax going over my strike, but I'm still in a bad position because I'm down a lot on the shares itself. And all I could do is keep collecting premiums to reduce my loss on the shares. So Square is a covered call trade as well. Bought it at 69. Right now it's at 64. So I'm down on the shares, not that much, but I keep collecting premiums by selling call options. Last one is expiring January 24th at a 69 strike. So even if it surpasses my 69 strike, it's fine because that's my cost. My profit will be all the call premiums that I sold for Square. For example, if I go to executed, look up Square, you can see I collected $1.90, collected $1.60, collected $1.35. And I think there's another one that doesn't show because it passed 3 months. And in this window of Questrade, it only shows the past 3 months. So yeah, I'm not worried if Square goes above 69, but it looks like it's far from it. It's at 64. So I'm just going to keep rolling the call option at the same strike. And then Yeti, I've got Yeti that I bought at 35.4, but my initial strike when I sold the call option was 33. So I'm comfortable letting my shares go at 33. I've got no problem with that. So what I've been doing is just rolling the call option forward, collecting some decent premiums on Yeti. So if I go to executed, look up Yeti. I've had it for more than 3 months, so it won't show all my premiums collected. But as you can see, for the past 3 months, I collected $2.45, collected 32 cents, and collected $1.24. And finally, in my RESP account, which I transferred from CIBC to Questrade recently, I've got some more Bombardier shares that I bought at around 2.25. So that's why my strike here is 2.25. So right now the stock is trading at 1.92. So it's not far. And I've got 500 shares of DFN just for the dividends because I didn't have enough to do a covered call trade. So I decided to just put it in this stock that pays a great yield of 14% per year. And then this is a very risky trade, but it seems to be retrieving a bit. But I bought this at 1.56 here. So I paid a net debit of 71 cents for this trade. Right now it's trading at around 89 to 95 cents. So right now it's profitable. I sold a call option expiring May 15, 2020 at a 1.5 strike. The stock dropped all the way down to 75 cents, but now it's back up to $1.24. And that's what is putting me in a profitable position right now. If I want, I could probably just sell it and get out of it because it was a pretty bad stock to begin with. I just went into it because of its really high premiums. Premiums were ridiculously high, and which explains why the stock went from almost $2.24 to 75 cents, but now it's coming back up a bit to $1.24. But if I wanted to close a trade right now, let's say to 92 cents, I bought it for 71 cents. So I'd be making 30. And I think I bought it back in, in September or October. Yeah, I think beginning of October I bought this. So it would be a profit of 29% in 3 months. So not bad. I guess I could do that. All right, so if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.